Hey Candice.
How's it going?
Hey, it's going all right. How are you?
Good. Is it Moira?
Moira, yeah.
Moira. Okay. Needed a little bit more there. Um,
No worries.
pull up the song that you wanted, which I thought was a fun one. And then I'll give you also hello. Sorry, I'm like rushing.
Hi. No, that's okay. Yeah, I should have come on a couple minutes earlier. Sorry.
No, 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 no. I just started it. This is all me. Um, but I'll give you share screen. Are you planning on
I have some slides. Yeah, we have
perfect?
researched some good maps and stuff I'd love to show folks. So
Love that. Okay, so I just gave you that ability. I'm getting rid of all the note takers. We don't have those guys. People kind of slowly trickle in, honestly, over like the first 10 minutes. We have some folks in the waiting room. I mean, is there anything that I can do to like make, or like we as a group can do to make this more effective for you? Or just a better use?
um well yeah, one thing would you be willing to share the link to our report?
Mm-hmm.
I'm gonna start off just saying sort of
Or,
like that as kind of the background for
yeah, yeah.
I have what I to share what I have to share. So let me pull up the link and then that way I don't have to try to do that while I'm also still trying to present.
Yeah, yeah, yeah. And I'll manage chat. The last 15 minutes we'll do audience Q&A. I'll just like as I'm watching and reading the report, think about questions to ask. Does it make sense to talk about Trump and like the sort of federal versus local side of this? Um, I might just ask those questions anyway because I feel like
Yeah,
what they
yeah.
do. Okay. Anything else?
I don't think so. Nothing that, yeah, nothing's coming to mind.
Okay, cool.
Cool.
Yeah,
Anything I should know about this crew? I mean, I know it's public too, so, but
no, it's pretty chill. I would say these are fairly informal in terms of like, say, I mean, it is recorded within Climate Vine, but like, feel free to say whatever you want to say. And most of them have some decent background in climate. And so they're not like totally new to the idea of climate. They don't need to like basically just go as deep as you possibly can as quickly as possible.
okay, okay. Can do, can do.
Okay, cool. So I'm going to play the song. Tell me if
Yeah.
it works.
We who believe in freedom cannot rest. We who believe in freedom cannot rest until it comes. We who believe in freedom cannot rest. We who believe in freedom cannot rest until it comes. Until the killing of black men, black mothers, sons is as important as the killing of white men, white mothers, sons. We who believe in freedom cannot rest. We who believe in freedom cannot rest until it comes. Not needing to clutch for power, not needing the light just to shine on me. I need to be just one in the number as we stand against tyranny.
Great song choice. I'm going to listen to Resistance Revival Chorus all the time, Moira. Okay, cool. So by way of very short intro, just so we can jump straight into the conversation. Moira, you are an independent consultant, research and policy fellow with Climate and Community Project, just how I met you. And I actually think Aaron Kozin, I don't know if he's here right now, but he was the one who was like, yay, there you are. He was like, gotta talk to Moira, really love the work that she's doing. And then I happened to see you in person at New York Climate Week, and it all worked out really well. And thanks also for the flexibility in me needing to reschedule. My pipe was frozen. So that was sorry everyone, but that was the reason. And she was very flexible. So I'm going to give you the floor since you have some things to share. And then I'll ask some follow-up questions. The last 15 minutes will be audience Q&A. But yeah, I'll give it away to you.
Great. Well, thanks so much. And hey, everybody. I'm just pulling up, I'm going to share my screen. So with a little slide deck here, it's not going to be too filled with text, but I did want to show you some of the maps and a few of the concepts that visually particularly for those of us that are visual learners. So yeah, to start with a quick intro beyond what Candice said, and thanks Candice for the invite. It's great to be here. So I'm a senior fellow with the Climate and Community Institute and also an independent consultant working with organizations on research and policy visioning for the just transition. Climate and Community Institute is a climate and economic policy think tank, and with a large network of fellows who work on projects at the intersection of climate and inequality. So last year, I led the team of fellows, most of whom are academics, as you see listed there on the authors list, where we spent about a year researching what's going on with home insurance, particularly disaster-related insurance in the U.S. The team listed there has expertise and studies everything from Florida's insurance markets to housing and climate change to municipal finance to wildfires and wildfire insurance, racial disparities on housing and public health. So it was a really great interdisciplinary team to look at this issue from a range of perspectives. And then we also collaborated with and got input from other researchers, policy analysts, housing providers, and grassroots community organizations around the country. Why did we embark on this project at CCI? We were witnessing, and in some cases, including my own, experiencing directly so the collapse of home insurance markets and its impact on communities across the US. But we were also observing that media and policy conversations about it were tending to focus primarily on questions of like, how do we rescue the insurance industry rather than really looking at root causes of housing instability, as in a country where climate disasters are becoming more severe and more frequent. And so we really wanted to look kind of behind the headlines at some of these overlaps of premium price increases, climate risk, and socioeconomic factors, and look at how they were playing out across the country behind these sort of beyond the sort of headlines of, oh my God, it's California, and oh my God, it's Florida. We also kind of wanted to, really dig into whether some of the media and policy solutions being presented were in fact, the best way to approach this question from a sort of a housing justice perspective, right? How are we really ensuring safe and affordable housing? And well, assuming at the time when we began that we didn't find that the policy solutions on offer were adequately doing that, to offer our own vision of some policy approaches that could do this, could take this housing justice approach, right? Protections for homeowners and renters, really acknowledging and meeting the moment of how the climate is changing, and of course, ideally contributing to solutions to the climate crisis as well. So we have sort of several sections in our research, and I want to talk through at least. I mean, it's a dense report with a lot of data analysis as well as qualitative analysis. So I'll break it down into some of our national level findings, some of our state level findings. We did deep dives in a few states. Some of our analysis of these sort of overarching narratives, particularly from the industry about how insurance works, and then finally I'll talk a little bit about our policy vision. So first, on the national level findings. So first, we really think this is a collective problem, despite some of those perceptions about maybe it just being a coastal issue or a single risk in each place. Now, I do think that unfortunately, honestly, events in the past 6 months have also made this quite clear, right? Hurricane Helene certainly helped make the point that these aren't just in the usual places, but also the LA fires did that, and we also found, even a little bit different than those examples, that multiple parts of the country face risk of significant losses from multiple hazards, right? So because we wanted to see how maybe some types of risk that were on their own don't cause too much damage, when they're overlap or compounded, that they could end up causing a lot of damage, which often happens with things like convective storms. Like you get heavy rains, heavy winds, strong winds, hail, et cetera, and that all piles up on each other. And one of the things we found were some unusual things or unexpected things, even for me, like parts of Florida have pretty high wildfire risk. I definitely did not know that. And sort of in some, almost 40% of people in the US live in areas of high risk of property damage and destruction. That map here is one way to view the layout of those levels of risk. And the second slide is another way. Because we wanted to look at how the risk plays out both in absolute dollar figures of property damage, but also in relative ones, right? That in places with lower property values, the absolute amount of damage might be less, but because it's a greater proportion of property value, the impact on those communities may very well be greater. And when we look at it that way, we see some real concentrations in places like the Southeast and the Upper Plains. And sort of one of our second conclusions from this national level analysis is that while we are all this together, this is a collective problem. It does impact certain communities more negatively than in others. So, we found that some racial groups are disproportionately exposed to some of these compounding levels of high risk. So, for example, 10% of all American Indian and Alaska Native households live in neighborhoods facing 4 or more unique substantial climate risks, right? And another often overlooked group here in these conversations are renters who face increasing housing cost burdens as insurance rates rise for the multifamily buildings that then building owners pass on to them, except in cases where there's tight restrictions on rental rates. Third conclusion from this national analysis, right? This insurance crisis didn't appear out of nowhere. There's a housing crisis with discriminatory housing practices that the industry has been involved in for a long time, right? Redlining wasn't just mortgage lenders, it was also the insurance industry. And some of the legacies of these discriminatory practices are still playing out today and connect directly to this insurance crisis. So there's a whole swath of folks who essentially cannot get insurance, even if they could afford it at these increasing rates, because they have what's called heirs property. Heir like HEIR, not like AIR. So this is a type of fractured ownership in which property is inherited, sometimes over multiple generations, among several heirs without a formal probate process. So like there wasn't a formal will or it was incomplete or what have you. So current laws actually make obtaining property insurance nearly impossible for this type of ownership. And Black and Indigenous households are the most impacted, with estimates saying over half of real property owned by Black households in the US is heirs property. And a lot of that is concentrated in the Southeast. And relatedly, these insurance price increases are stymieing efforts to build more and greener affordable housing, which is then further exacerbating housing affordability and availability. We interviewed a number of affordable housing developers and providers who affirmed that they're canceling projects, both new housing as well as green retrofits, because of these rising insurance costs. They can't pencil it out. So moving on to some of the state level analysis, we did some deep dives into Florida, California, and Minnesota in our research. And if obviously the exact nature of climate risks, housing affordability and availability issues, regulatory environment all differs in each of these states. But from that analysis, we draw 3 conclusions that we think can apply certainly across these states and very likely across other states. And we're hoping this year to do some more state level analysis. So first, existing state policies to rescue private insurance, which largely are deregulation and financial incentives for the industry, are not addressing the root causes and on-the-ground experiences of household exposure to disaster risk. And Florida is a great example of this. So Florida Citizens, which is the state's insurer of last resort, operates now, because of this sort of deregulatory and financial incentive approach for the private industry, operates with what's called a depopulation mandate. which requires it to offload policies to willing private insurers, right? And that's based on the idea that it's better for policies to be in the private market. But this hasn't actually worked. According to that theory, Citizens is now the largest insurance company in the state with more than 1 million policies, nearly 1 in 10 Florida homeowning households. But current law also requires Citizens to charge more than private insurers. And so that means that premium burdens for Citizens policies are strikingly high, right? In several zip codes, we're seeing people paying 5, 6, 7, even up to, in some cases, up to 10% of their income on Citizens policies. And that's income just on your disaster insurance policy, right? Not to mention all the other things you have to pay for, right? In California, which is where I live, the state fair plan, which is what it calls the insurer of last resort program, is also taking on increasing numbers of policies in certain parts of the state. Logic, we did this research before the LA fires, but logic tells us that insurers will likely pull back even further than private insurers will pull back even further than they already have been doing before the fires. And those that stay will seek to jack up rates. And in fact, there was just an emergency request this week from State Farm to ask the insurance commissioner to let it raise rates essentially immediately, an average of 22% across the state. And so then that will continue to expand the unaffordability and unavailability of insurance here in California. So another conclusion from the state level analysis that there are some programs to do risk reduction to actually make housing more resilient to these climate related disasters and big disasters more broadly, which is good. And yet existing measures at the state level, and frankly at the federal level, are not being deployed at the scale and pace required to adequately reduce these growing risks. And they're definitely not doing so in a way that solves for equity. So for example, the state of California has implemented a program that provides financial assistance to support wildfire hardening for homeowners. Yet evidence that we found indicates that the retrofitting is not proceeding at the scale needed, not at the individual home or community level, nor in a coordinated way. And we also found these programs in other states like Minnesota are often only applying to homeowners, which means that multifamily housing, affordable housing, and renters aren't getting any of these kinds of benefits or protections. And then third, one of the kind of solutions that is sometimes proposed about this disconnect between the risk reduction and the jumping of premium prices is that there should be a mandate for premium discounts when retrofitting happens. But we found little evidence of this meaningfully changing community level risk profiles or reducing household insurance cost burdens. And I'll say more about this sort of logic of premium price and individual retrofitting in a moment. So yeah, and this is a segue to that. We did some analysis of some of the sort of narratives and theories that the insurance industry and sometimes are repeated in the media and by policymakers about how home insurance works, how it should work, how it could work, why this crisis is happening. So we examined some of those, and I want to share a bit of that. The first point is that instead of prioritizing protection for people's homes, private insurers are engaging in speculative maneuvers to secure profit, and that's often getting enabled by regulators. So Florida is a really great example of this. More than a dozen insurance companies have exited the Florida market in recent years. And just since 2022, at least 6 insurers in the state have become insolvent, which then leaves homeowners scrambling to find new providers, typically at dramatically increased prices. But it's important to note that these insolvencies haven't necessarily meant that profit isn't being made. State deregulation has allowed the proliferation of these small so-called specialist insurance companies, some of which they're the ones that I was just referencing having gone insolvent. So they offer policies like for a specific peril, say maybe like just wind in a specific region, say just wind in South Florida, for example. And one of my co-authors did separate analysis on this, separate from our report, and found that essentially that the primary purpose of these companies is to write a bunch of policies for a couple of years, 2 or 3 years, for the purpose of attracting and profiting from investment capital. So they don't need to stay open for more than a handful of years in order to then make profit. And a parenthesis here is that I think it's really important to make sure we're on the same page about how insurance finance actually works. I'll stay as basic as possible, but I often talk to folks who repeat this misconception and actually see it sometimes repeated or sort of reinforced in media coverage of this issue. The misconception is that insurance company finances are essentially a math problem of premium income minus claims payouts equals how well an insurance company is doing, right? But it's much more complicated than that, actually. Insurance companies typically do three things with premium income, right? So they bank some of it, they retain it, they invest some of it for profit, right? In the stock market, in bonds, what have you. And the returns on those investments, right, can either go for profit or they can go for claims payouts. So and climate campaigners have long pointed out some hypocrisy here, because many insurance companies are also investors in fossil fuel, which of course is the main cause of climate change. And then finally, insurers will engage in risk transfer. So that includes things like buying their own insurance, which is usually called reinsurance. And then risk transfer financial products like catastrophe bonds, et cetera. I won't get into those now, but we could talk about that in Q&A if folks want to. But yeah, it's really important to understand that it's not just this simple premium income minus claims payout. Okay, back to the presentation. So the other conclusion from this analysis is these current policy choices, like I've described, are shifting around the financial risks of major disasters. Primarily, it would seem, or at least the outcome is protecting of industry profits rather than reducing financial risk to households and physical risk to homes, which is obviously what I would argue is what is the most important goal. And that's despite findings about how much money can be saved when we actually engage in proactive risk reduction, and of course those the continued proliferation of fossil fuel production. There's also a lot of critique of these sort of semi-public insurance programs like the National Flood Insurance Program or like these state insurers of last resort. There are a lot of valid reasons to critique them. And in fact, my colleagues and I argue that part of what we should be critiquing about them is they're not well designed. They're not good insurance design, right? They don't sort of follow the fundamentals of pooling large amounts of risk and spreading it across different types or levels or geographies of risk. So as an example, the NFIP, the National Flood Insurance Program, only covers one type of peril, flood, and only for the highest risk of properties of flooding, right? So that's kind of like a health insurance program that only covers the sickest cancer patients, right? Like, we get that won't work, and so why do we think it'll work with home insurance? And finally, we examined this like really sticky idea in the insurance world about risk-based pricing, which essentially is the idea that setting premium prices based on risk level is an effective way to get people to reduce risks. But we don't think that this actually works in practice. If you look at the world, it's hard to see evidence of it working well, and it definitely causes unacceptable equities. So just to give a few examples, right, and that probably can connect to your own life or those of people that people make decisions about where to live for all kinds of reasons, right? Where schools are, families, jobs. Also, like, if the interest rates are really high and you can't afford to move, which is kind of my case, right? So, or maybe if somebody's lived in the same place since way before these climate-driven disasters were the problem they are today, and yeah, they can't afford to move or what have you. Also, lots of people can't afford to pay up front for big retrofits. particularly if there aren't, grants and other support from those risk reduction programs that we talked about earlier. But even if there are, sometimes that's not enough for a lot of households. And also, and I think this is really important particularly for those of us who really understand how climate change works, right? The necessary risk reduction measures to respond to these big disasters, right? So we might think of sewer upgrades or neighborhood like wildfire prevention with brush clearing aren't measures that individuals can take on their own, right? So yeah, we really think my co-authors and I really think that the U.S. home insurance system is fatally flawed, particularly in this context of growing climate disasters. Right, we're seeing the vast majority of this disaster risk reduction and response for households getting left up to these private insurance markets. But as some of the evidence I talked about and evidence we've seen, I'm sure in our own lives or in the news, the approach of these insurance companies, which is focused on profit seeking and transferring risk away from themselves, is not proving adequate to the task. So instead, we're getting those financial burdens and risks borne by households, right, which can lead to financial ruin, which can also contribute to financial system risk. Or I think probably it's getting socialized into public disaster programs that are reactive and are, at least at the federal level, maybe at risk right now. So yeah, we really think that we must reimagine how this disaster risk finance system works so that we're really reducing risk and providing protection equitably and fairly. So what we propose is something that we're calling housing resilience agencies. We focus in our report on state level agencies like this, or an approach at the state level, in part because insurance is regulated at the state level, and because some of the risk reduction measures, tend to be, and we think have a lot of logic for being at kind of that regional level as opposed to a federal level. We wrote this before the election, so it was probably prescient, but we could imagine a version of this at the federal level in some future, with some changes into how it's designed, but something like this could be imagined at the federal level as well. But just to give a quick overview of what our proposal is, we think there's sort of two key parts to this work. One is coordinated and comprehensive disaster risk reduction. So we're preventing and lessening damage before disaster strike, right? The more we build resilience, the less we need to rely on the safety net of insurance. And we need to be thinking about this holistically, right? So it's everything from deciding where it's too risky to build new housing, right? So this is a land use question, zoning question, helping people relocate from where it's too dangerous to stay, and carrying out community-oriented mitigation efforts, right? So like an anecdote I reference is the sort of more individualized approach that often happens now. If we're, say, in a hurricane or a high wind area, it says, oh, okay, Moira, you should put on a new roof. Great, here's a small incentive to do that. Okay, I have the resource to do that. Cool, I'm going to put on a new roof. But then we have a massive windstorm, hurricane. My neighbor couldn't afford to put on a new roof. Their roof flies off and smashes into my house. Well, I still bear a lot of damage because we weren't thinking about this holistically, right? And sort of in a community-oriented way. The second key pillar to this approach that we propose is public disaster insurance, right? So these disasters, as I've been describing, and I think this community will understand, are collective, right? Individuals didn't cause them, didn't cause climate change to make hurricanes worse or wildfires more likely and the like. And we can't individually prevent them or meaningfully mitigate those risks. So we should have a response that is recognizing that collective and also recognizing that the more we spread risk over populations, over types of risk, the better insurance will work, right? And we want the public to reap the benefits of the risk reduction work, not privatizing those profits. So we imagine a public disaster insurance program that would provide coverage for all household types. So homeowners, renters, affordable housing providers, mobile home dwellers, you name it. And we imagine that private insurers would still do the little things like, the standard home policies, kitchen fires, burglary, pipes bursting, and the like. Um, yeah, and then, I can, we have a fairly extensive outline of how we think this could work. Just a couple of, to name a couple of the features that we propose: public catastrophe risk modeling, a democratic governing board with members from policy, civil society, scientific communities. Yeah, we also think the financing for this we should think creatively about as well, right? And particularly when we're talking about insurance, which in some ways is a tool for determining responsibility and accountability and compensation. We think we should use that same framework to think about, okay, well, who's contributed? What entities have contributed the most to this crisis? Fossil fuels, certainly. Maybe there's a super fund, bill, or there's a tax or what have you. Also, the private insurance industry has definitely not done an adequate job of addressing this growing crisis. And also who would benefit, right? So mortgage lenders, a lot of mortgage lenders, particularly regional ones, are really are scrambling now as properties that they either already lend to or would want to in the future are becoming uninsurable. So they have a lot to benefit from a more stable system. We also think states could collaborate. So maybe we could imagine a California, Oregon, Washington housing resilience agency that pools, even more resources and spreads risk even more. Anyway, I'll leave it at that for now. I know there'll be questions and whatnot. And yeah, I really look forward to this discussion. I'll just say we really think that public programs to provide fair and equitable disaster insurance protection, coupled with that coordinated, comprehensive disaster risk reduction, is the way forward in this crisis. All right. Thank you. Let me try to yep, okay. Did I undo the
I can do that for you.
Okay.
Forcibly end it.
There we go. Yeah, it was on my other screen. I couldn't find it.
No, you're good. Thank you so much for that fantastic presentation. So I think what I'm going to do is like a very quick high level of my biggest takeaways, but quick, right? Summary, and then go straight into audience questions. I think there's some really good ones, and then I might be able to get in some of mine in between. But I think let's just do a shared Q&A with everyone, because that was just such a good, deep presentation. So the summary document that you guys have alongside the longer one, the summary document is awesome. And I was taking my own summary notes, but I'm going to reference both. So the first one that it says is it's a housing justice issue and it impacts people unequally, right, along social lines. Some of the things that I thought were fascinating were the relative versus the absolute price, right? And when you look at the relative damage, Southeast or sort of poorer areas, I think are a little bit more hurt with that. The idea of compounding events risk, like I'm from Michigan and I've always thought, oh, it's like not very risky. And it's actually seems pretty risky, except for the UP, maybe because of that compounding risk. And so that was a reframe for me. The idea that the increase in insurance is passed off to renters, I think, has been there, but this air law was really new to me and interesting. And again, this justice piece that I think you did a great job of just pulling out. The fact that it's also stymieing efforts to build more and greener affordable housing, and that you've spoken to people that are canceling projects, was another big takeaway for me. I'm sorry, I'm just trying to give you my takeaways. I don't know if this is because you're just like, okay, yes, I just said this, but just hopefully it's helpful to quickly just talk about what isn't working is the deregulation financial incentives, the risk reduction programs right now that aren't really great for renters and really not doing enough. And then premium discounts for retrofits and just the equity issues there. You talked a little bit about reinsurance and said maybe we should talk about that a little bit more deeply in the Q&A, which I think would be interesting. And then the solution side is, instead of taking the public insurance model today, which again, and correct me if I'm getting any of this wrong, but today seems like basically like a bailout, right? Where it's less, maybe it's not a bailout, but it's more of, let's take the biggest risk pieces out of the private insurance companies. Let's put that into the public hands. And of course, that's going to fail and cost a lot of money and not actually create this feedback loop that would be required. And so instead, there's a public solution that you all have proposed that is more, I don't know, holistic, that actually could work And that is more at the state level and addresses some of these market failures alongside the state side. Is there anything that you want to add in that you're like, this is a really critical point that you didn't summarize?
No, that seems exactly right. I'll just a couple of like precisions, I think, on
Please. Yeah.
the like I'm sorry, the yeah, retrofits for premium reduction piece. It's both, it's also about how it's not as effective because of the way that like if my neighbor doesn't do a thing,
Yeah.
that might hit me anyway.
Mhm.
Or that there's sort of some of this stuff is more bigger infrastructure changes that are needed.
Mhm.
Um, and then, yeah, on that last piece about what we currently have, I think you put it well in terms of sort of yeah, being a last resort thing. And almost, I mean, another way to maybe think about it is that what we should have as a first resort response, that would operate more effectively, and yeah, not just be kind of like a rescue for these private companies that aren't actually prioritizing
Mhm.
household,
Yeah.
safety and
And
effectiveness.
the last thing I'll say that I think was a through line for me was like going from individual risk and responsibility to more communal risk and responsibility. Okay, cool. So again, I'm going to save some of my questions for later, but Jameson, you have a couple questions. Why don't we just start with start with your favorite one, and then we'll get you up here for your second one later.
Sure. Hi, Mara. I'm also calling in from California, so nice to meet you. I've worked in the climate risk adaptation field for a while, and so I'm pretty familiar with a lot of the challenges that are currently presented, and know that folks have been trying to figure out the solution for many, many years. A while back, I was the project manager for the Risky Business Project, where we were trying to talk with a lot of the financial sector and business sector, and had some conversations with insurers about this. And Munich Re was one of them. And that was over a decade ago. They were very aware of climate change, very much paying attention to it.
Mhm.
Um, but would love to hear how kind of reinsurance, which is, to my understanding, like insurers, right? Um, they're acknowledging climate change, but how is it actually impacting their business model? Is it impacting their decisions, or is it still kind of business as usual for them?
Yeah, great question. And I'll do a tiny bit of background for other folks. So, right, I briefly mentioned reinsurance. Reinsurance is insurance for insurers. And most reinsurance, so Munich Re, right, the Re is the reinsurance, right? So it is basically a reinsurance company. A lot of the reinsurance companies don't also do direct insurance, primary insurance. There are some, like State Farm has a part of its business that does some reinsurance, mostly for its own companies, if that makes sense, for its own subsidiaries. But yeah, generally speaking, the main reinsurance companies are just reinsurance companies, and they are global companies, shall we say. So most of them aren't headquartered in the US, and which means we can't do much regulation here, and most other countries don't do much regulation. So that's important both because there's not a ton of information that we actually know about how they work beyond what they voluntarily share, right? One benefit of regulation is you can require data to then that academics and analysts and advocates can analyze, um, and policymakers, of course, too. Uh, and also because then if there's no regulation, it can be kind of they get to operate how they want. And I think for the purposes of this conversation, that's important because yes, Mina Gray has been talking about climate change since the 70s, if I'm remembering the date correctly. And some of the reinsurers themselves, because they're a step removed, they are restricting also their issuance of reinsurance. They're saying, sorry, State Farm or Allstate or Liberty Mutual or whatever, we're not going to give you reinsurance, or we're going to charge you a lot more. And so that's their way of addressing it. And in some ways, that's not dissimilar to the Liberty Mutuals and the State Farm saying, sorry, policyholder in California, we're not going to give you any insurance, or we're going to jack up your rates. And so that's their response to climate change, which is perhaps a rational response, at least in the short term from a business perspective. But it certainly isn't a good good public policy, or it isn't a solution to this public policy problem. And I I have a trouble understanding how it's a good medium to long-term business decision, honestly, because if you're saying we're not going to provide the service that is the core of our business, well, then what is your business going to be in the medium to long term? So that's a question that I still is open in my mind.
Thank you so much. Yeah, that's really insightful and appreciate your perspective. I haven't been paying attention to this for a while, so it's helpful to get that update. And also just want to express appreciation for the work you're doing and the analysis. And I'm very interested in digging into it. So thanks.
Thank you.
Amazing. Thank you, Jameson. So Bonnie, if you are able to go on video, feel free to, and I'll bring you up. Great. Thank you.
Hello. Hi. I live in this climate fintech finance space, and insurance is a big question consumers have. They feel largely unprotected, as you mentioned. And I was just wondering, is there anywhere in the world that's doing this right? Is there a country that's we have reformed our insurance market so as to protect both homeowners and renters, and we have a stable market that at least has some foreseeable future and is risk adjusted? I'm just curious.
Mm-hmm. I mean, I can't say that there's a perfect example in the world, unfortunately. We relied a lot on New Zealand as a model to iterate off of. Well, the best way to say that. They have a program, which is a federal disaster insurance program, in which basically you pay an additional fee, a standardized fee on top of your standard home insurance policy that then essentially is your premium for the National Disaster Insurance Program. And then you're covered by this National Disaster Insurance program. So yeah, that has sort of the closest to what we're proposing. Obviously, scale and whatnot is different. And yeah, other countries have different models and are experimenting with different things. There's a really great book called Disaster Insurance Reimagined that some scholars in Australia and the UK, if I'm not mistaken, published a year or two ago. And it's available as a PDF online, that I would really recommend too, if you want to dig more into sort of how other geographies are experimenting with this. But yeah, like I said, New Zealand was kind of our primary model.
Cool, thanks. That's interesting.
And I think this might be a link to the book, so I'm just adding that in.
Oh, great. Thank you.
I'm going to ask one of my questions, and then Jameson, I think you should ask your second in terms of who's getting upvotes, and then keep asking questions in the chat. But mine is around parametric insurance. And so we had someone come in who's starting a company that does something in the parametric insurance space. And I'll share the link to them, to Climate members, if you want to have a reminder of what this talk was. But it was from, I think, more of a tech person who then got into nature risk and then was getting into insurance because it's all, has some intersection. And I learned what parametric insurance is, which but I'll just say because I didn't know at the time, which is you get paid, like the insurance company, I think, and tell me if this is wrong. The insurance company will say, if there's an earthquake of this magnitude, or if X thing happens, we will pay you Y amount, right? So it's all set out in advance. And in theory, that's supposed to be helpful to underserved communities, right? That would need that money pretty immediately. And they don't have to do any long sort of insurance things to get the money. It just is there. And some of the other things that he's working on is within the parametric insurance space is essentially enabling payouts to communities that do certain things as well, or reducing their premium discounts. It's kind of like the retrofit thing, but for ecological forestry practices, where if they reduce their wildfire risks by doing certain things that are known to reduce it from an ecological forestry sort of place, then they'll have lower insurance premium discounts. There's another about nitrogen reduction in agriculture. Does that all fall under the retrofit doesn't really work as well, or where would you place that sort of solution, or do you really like that solution coming out?
Yeah, no, I think so. On the last piece, I'll start with the second example, second version. I think there's a real difference between community-oriented risk reduction leading to premium reductions versus individual. Because of the collective nature of these kinds of disasters, we need to be thinking, part of, one of our main messages, as is probably quite evident by now, is that we need to be thinking about this more collectively, right? And so yeah, that kind of an approach has a lot, I think, to recommend it. And we reference something like that as a possible feature of the Housing Resilience Agency proposal. With parametric insurance, I think it is a, should I say, like a tool that could be a useful part of the toolbox, but it cannot be a standalone solution. And the reason I say that is because, I mean, your example was great. A magnitude, say a 7 magnitude earthquake, really serious earthquake, right? Hits and yeah, people need to recover. Like, there is a problem with the delay in how long it takes to get payouts and emergency support and all that stuff. And so we need to find solutions to that, and that might be a good solution for these really severe things. But like a 6.9 hurricane earthquake is also really severe. And if you only get any kind of support, any kind of payout at 7, what happens at 6.9 or 6.8 or 6.7 that are also really quite severe? And so I think parametric insurance can be part of the solution, but it can't be the only thing.
Are those two separate things, where one's parametric insurance in terms of payout, and then one is just different rates depending on your communal like resilience efforts? Does that second one have a different name?
Yeah. Yeah, what would that be called? That's not, it's not the same thing as parametric insurance. I'm not honestly sure at the moment if there's a technical term for it.
We should create it. The Moira.
Yeah.
Okay, Jameson, we'll bring you back up for your second question.
Thank you. The retrofitting program here in California, it's kind of been lauded and great things have been said about it. And you mentioned that it's not being used as much or fully subscribed or whatnot. And I'm curious from your perspective if that is because folks just don't know about it. Like, would an increased education awareness campaign help with that? Or, as you were saying, are the retrofits just too high in general? So even this additional funding from the state isn't enough? Would love to hear more why you think it's not being fully used.
Yeah, I mean, I think that there are, so I'm a homeowner in Northern California. I live in Oakland, and our house is 100 years old. And like stuff has been going wrong a lot lately. And like my partner and I have, sufficient means to, so far we've had sufficient means to like address the windows, some of the windows leaking and this and that. But it's also like really hard and stressful to figure out, okay, what is actually going on? Who can fix it? Like how to even talk about what's wrong with these people and what their prices are, let alone being able to actually afford, tens, 20s, $30,000 worth of work. Or even like, and if I'm working, 2 jobs and raising kids and also taking care of my elderly parent, like, how do I have the time and capacity to deal with that? So I actually think that part of the problem is that it's the individual approach, right? I've already named that in this context of these collective disasters is a problem. But also I think the assumption that people, particularly lower income folks, can actually just like deal with all of this in the context of all of the other, burdens and barriers that they deal with. And so one of the things that we suggest in our proposal is, could we think about a different way to approach this? Like maybe it is, there's a department of, or I don't know, subset of the Housing Resilience Agency that is tasked with identifying communities where, they're in desperate need of some of these retrofit measures, that particular risk for whatever the thing is. And they go to the communities and say, hey, like, we've identified your neighborhood. We see from our state like tax records that you're low income, like we don't need to file a bunch of paperwork to prove it. We want to offer you support, like we will send a contractor to look at what you need, and then we will, pay everything beyond $5,000, which we have determined you can afford based on we know your income, or something like that, right? Where it's like actually making it possible for people who have all these other barriers to actually do the thing.
Yeah, there's in California, I don't know about other states, but there is a similar program for building decarbonization that they just have. So I'm wondering if there's a parallel effort to that, or if as part of that moving forward, they could add this piece to it. Because
for sure. Yeah. My dream would be
right?
those things are happening together. Yeah,
Yeah.
absolutely. Absolutely.
Great. Thanks. And I live in Alameda, so we'll have to grab
cool. Yeah, I'm
coffee
in
sometime.
Oakland.
Yeah, we have a lot of Bay Area folks. So David, we're going to have you talk about catastrophe bonds and then that example that you shared, and just get Moira's feedback.
Sure. Hi, Moira. Thanks for the presentations. Super great. First, I would just love for you to explain what a catastrophe bond is. I've heard it a ton thrown around with respect to climate risks, and I've never really understood what's going on there. And then second, was wondering how much you know about the Coastal Restoration and Protection Agency down in Louisiana, and whether that's like the best state level analog for a potential resilience agency that you've identified in your research, and or if there are other ones in the states that also match that scheme. So yeah.
Yeah. I might have said this otherwise, but since we were just talking about parametric insurance, it's occurring to me that there actually are some parallels between parametric insurance and catastrophe bonds, in the sense that a catastrophe, like an insurance company is going to issue a catastrophe bond that might say, sort of, let's use the inverse of what we were talking about, an earthquake that's 7 on the Richter scale. And so they know that they're going to have to make a bunch of payouts to their policyholders. So they issue a catastrophe bond that says, the payout to us comes from the bondholders if that 7 on the Richter scale earthquake hits. But if it doesn't, you all are good and don't have to pay us anything, right? So it's almost like the inverse. And so, yeah, so there's lots of sort of versions of this that exist. And then another thing that's been happening is that, similar to mortgages, particularly in the lead up to the financial crisis in 2008, financial services companies are, packaging bunches of these and then selling them on securities markets. So there's this whole industry of insurance-linked securities. And so one of the things that colleagues of mine who sort of focus on, things like mortgage markets and financial system interconnection and stuff are starting to say, this is looking not good. This is reminding us of a few years ago. So yeah, it's an important thing to be paying attention to for sure. And then you asked about, I'm sorry, I've totally forgot what else you asked about.
No worries. First, just to follow up on that. So it sounds like it's kind of like another form of reinsurance. I mean, it's not insurance, It's not an insurance policy, but it's another kind of way for the insurance company to spread risk, but in this case, using a bond instead of a policy. Okay, interesting. Yeah, the second was a question about Louisiana's Coastal Protection and Restoration Agency. And, in your research, if you think that's like a really close analog for this overall state resilience agency idea that you're proposing, and or are there other examples in the US of agencies like this that are already doing analogous sort of work, if not exactly what you were envisioning?
Yeah. Well, I don't know a ton about the Louisiana program. We didn't do a deep dive on Louisiana in our initial report. We are doing some collaborations with some groups in Louisiana, and actually next week we'll be releasing some data analysis on homeowner insurance premium rates across the state, and it's quite shocking, I must say. So keep an eye out for that. And hopefully we'll be doing continued, collaboration with folks in Louisiana, and may very well be digging into this very question that you're asking. So I can't say much. I will say, I mean, just from even the name, it's clear that while it is doing one part of what we're proposing with the Housing Resilience Agency, it's not doing the other part. So it is, at least has a similar sort of intention of resilience and risk reduction for households. Though I can't speak to its efficiency or effectiveness or equity or whatever. But it isn't, Louisiana definitely doesn't have a public disaster insurance program. It has a last resort program, which it calls Louisiana Citizens. But it is that sort of what we say is a flawed model of sort of last resort, most risky, higher prices. And similar to Florida, it requires higher prices to be charged, if I'm not mistaken.
Totally.
So
Yeah,
yeah, and
appreciate
then of other examples, I mean, I think there are like not exactly, not ex I just learned yesterday that apparently the governor has proposed, although hasn't released any details about how he thinks it will work, here in California, a proposal for like a housing and homelessness agency, to kind of like bring together all the disparate pieces in the state that are trying to address housing and homelessness. And I think, again, without actually knowing much more than that from what's been reported, there's a similarity there in the intention of, let's think about this holistically. We can't disconnect insurance from risk reduction, but yeah, it doesn't exist yet as far as I'm aware.
Gotcha. Thank you for your response. Super helpful.
Yeah, of course.
Thank you, David. Tim, I'm going to have you maybe take us home.
Sure. Thanks for all this. One of your slides showed the benefits of pre-retrofitting stuff in terms of resilience, having a 13-to-1 payout version. Have you heard anybody of doing, using parametric insurance to deal with that? I mean, it seems to me that somebody could spend money now, or a municipality could spend money now funded by a bond, buy the parametric insurance policy. Then when the disaster hits, they have 1/13 the damage, and the parametric policy hits, that those proceeds go pay the bond instead of anything else. And you sort of did it you kind of prepaid or sort of prepaid for what's going to have to happen in the future by having the policy in place that trips paying off the bond at the end. And you would have spent the full resiliency money instead of the repair money. I mean, I'm all for parametric insurance rushing proceeds to the disaster, but if you paid 1/13 the amount ahead of time and the parametric policy bails you out of everything you spent, that sounds better. Or there seems like there's a lot of gap for that to be priced well if it's a 13-to-1 payout.
Yeah, interesting. I'm not familiar with any, but I mean, it's an interesting idea. I haven't thought about it more than the 10 seconds you were describing it, but it definitely seems like there's something worth exploring there. I mean, it does bring to mind the fact that a lot of municipalities are beginning to have or are foreseeing the likelihood of their bond ratings decreasing as the insurance crisis seeps into home value depreciations, which then, of course, flows into municipal tax revenue. And so that could make what you're proposing more difficult potentially, although maybe it's also a proactive way to, if you lock it in now before it happens. So
might be the way to save yourself. I mean,
Yeah. I mean, some of the collaborators on this report are much more focused on municipal finance than I have been in my work, and so they'd probably be best to answer these questions. I think we hope to be thinking about some more of those questions going forward, but haven't a ton yet, unfortunately. But it's important to pay attention to, absolutely, because the home insurance coverage is essential to the structure of municipal finance through property tax revenue. And if that starts to fall out from under us,
and the entire economy, but yeah.
Amazing. Well, on that note, I think that might be where we're ending. Tim, I sent you a note to maybe we can follow up with review, and then maybe we could follow up with you, Moira, with like anyone on your team that's working on that. If I can sneak it in, the last question before we say thank you is just like, how do we get something like the state level HRA to be done? Like, what are you guys doing work on that? Can we be helpful to that? What are the next steps?
Yeah, great question. I'll just to maybe end on a slightly lighter note than that exchange with Tim brought us. There's been a big outpouring of interest in these questions, and I think and in willingness to think creatively about it, and that is giving me some hope. And so what we are doing, so CCI, right, we're like is a think tank. We're not an advocacy or campaigning organization, but what we do is partner with and collaborate with local, state, federal organizations on their work. And so Yeah, we've been building and would love to build more if folks here have connections or are part of organizations that might want to do additional research, want us to help do research that feeds into your campaigning or advocacy, like we're doing in Louisiana, where we're releasing this data memo that then advocates and organizers there are going to be using in their advocacy with the state legislature. So that's the invitation.
Cool. Thank you for that. This was fantastic. And I just want to really thank you. And if anyone wants to go off mute and say thank you to Moira as well, feel free to reach out to her, but just thank you for doing this work and sharing it with us as well.
Yeah, absolutely. Thanks so much for the opportunity. It was, and the great questions, really engaging conversation. Thank you.
Thanks, Moira.
Thank
Great.
you.
Thanks, everyone.
Bye, everyone.
Oh, and a little participant too.
Very cute. We'll end on him or her. See you guys. Bye.